If you haven't noticed, Trump is having a massive impact on markets. Recently, the uncertainty around his tariff policy has caused a sell-off in some stocks and the broader market. It's also causing a real economic shift as well. For example, TSMC just had a press conference yesterday announcing a $100 billion investment in U.S. manufacturing. That is to build out their new Arizona Fab campus. Why are they doing this? To shift the supply chain and avoid new tariffs on semiconductors being sent into the U.S. This will hurt the profit margins of companies like TSMC, and downstream will impact the margins of all of their major customers. And these are big companies that are likely in your stock portfolio, like Apple, Qualcomm, Nvidia, AMD, and Broadcom. As the great investor Charlie Munger once said, "You show me the incentive and I'll show you the outcome." And it appears like tariffs are quite the negative incentive. And this is really just scratching the surface of the tariffs being put in place. You have the reciprocal tariffs coming on April 2nd, 25% on Canada and Mexico starting today, and a just announced 10% increase on China tariffs. So all of this has a real impact on the economy, the world, and the stock market. And I have no doubt this is going to create a lot of headlines in the news and a lot of uncertainty in the stock market. For example, you can see just today, Nvidia went down 8.6%, Broadcom went down 6%, and TSMC went down over 4%. The S&P 500 was down 1.72%, and it's had a particularly rough past few weeks. But for the intelligent, long-term investor, this kind of volatility can actually create opportunities. Personally, I have been buying some very high-quality tech companies like Microsoft, Alphabet, and Salesforce. I just discussed why I'm buying these in my latest portfolio update video, so you should go and watch that for an analysis on each of these stocks. I would consider these companies to be largely insulated from the impact of tariffs. And overall, in my personal dividend portfolio and all my investment accounts, I pretty much don't have very many stocks that would be directly impacted by tariffs. And this is part of the reason why I like investing in individual stocks. That way I actually understand what I own and I can maintain my conviction no matter what news is being thrown my way. When you just invest in the index, you're kind of at the whim of the news cycle and everything. And I think it can become far easier to become disconnected and make emotional decisions about your investments. But that's just my personal opinion. You could also just dollar cost average and keep your head down for the decades to come. So even though I feel good about my investment strategy under this tariff policy, there are still a lot of high quality companies that will be directly impacted from the tariffs. So today I'm going to give my top 5 tech stocks to watch. And a little bit of a spoiler alert that will be related to the latest TSMC news. And I will importantly give my updated thoughts on Apple, which is a company I own a position in, and one that likely everyone who invests in the stock market does as well. For example, if we take a look at the S&P 500 index, Apple and Nvidia are the 2 top holdings. That's 13% of the index by itself. So these are important market trends to follow. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using the best stock research tool, which is available at dividenddata.com. We're currently doing a special sale where you can get 50% off our annual membership. This is a special opportunity that will only be available for a limited time, and you can lock in that half off price for life. Click the link in the description and pinned comment of the video to get access to the sale. Or if you sign up via the web app directly, enter the promo code MARCH at checkout of the annual plan. That's the month, March. With that said, let's dive into the analysis. For stock number 1, I have Taiwan Semiconductor, ticker symbol TSM. This stock is currently trading at $172.97. They've been selling off a lot lately, down 23% from their all-time high. And really the 2 main factors right now impacting their business and the broader tech industry is the trend around AI and in hardware, tariffs. Now, if you don't know TSMC, this is one of the highest quality companies in the world. It's really impressive. You should go and learn about the whole company's history. It's a great story. By the way, a great resource to do that is to go and listen to an interview with their founder, Morris Chang, which just released from the podcast Acquired. They do a fantastic job, by the way. Today, they are the world leader in semiconductor manufacturing. They innovated by developing the foundry model, where they basically manufacture chips for all of these other companies that focus on design. And that allowed for the entire rise of the fabless semiconductor industry, which powers some of the biggest companies today like Nvidia, Broadcom, and Qualcomm. I'm not going to do a full stock analysis today on the company, but they are locked in with a very dominant position and a wide economic moat. Their only risks come from geopolitics, given that they're in Taiwan, and also developments like tariffs. I think it's important to explain also who is paying the tariffs in this scenario. So the tariff is paid by the importer. So it would be the companies being Apple, Qualcomm, Nvidia, AMD, etc., that would pay the tariff as they import the TSMC chip. However, it is very common for companies, especially on a large scale, to negotiate with each other. So TSMC may share in some of that cost burden. Alternatively, they may pass that increased cost onto the consumers by raising the prices on their end product. So no matter what, the cost will exist in some factor. Now, what's interesting is Taiwan Semiconductor is crushing it right now. They just hit all-time highs in earnings per share. And even with this recent sell-off, the stock price is very high compared to its historical price. And the big deal to watch right now is that there is a proposed 25% tariff on imported semiconductors, and that is set to begin on April 2nd, 2025. And despite TSMC's new investments, these chip fabs will take many years to build and reach production volume. So over the coming years, TSMC will be impacted financially by this. What that means is their growing profit margin will likely come down. For example, in fiscal year 2024, they had a 40.5% net margin. That is wildly impressive considering that they are a manufacturer, especially when you consider these chips are then marked up significantly again by the likes of Nvidia, Broadcom, etc. So we're going to see an interesting market dynamic play out, as TSMC will likely raise prices to combat these tariffs. Pricing of these tariffs will be impacted by the likes of Apple, Qualcomm, Nvidia, AMD, Broadcom, and all of TSMC's customers. So let's jump into those stocks. For stock number 2, we have Apple, ticker symbol AAPL. This is the most valuable company in the world, currently valued at $3.58 trillion. And in my opinion, it is the most overvalued of the big tech stocks. And I frankly find it so surprising they are only down 2% this year. I actually don't get it. I mean, Apple is an extremely high quality company. They have a great product ecosystem, a great brand, an economic moat. But of the big tech companies, they are the most at risk when it comes to tariffs. They are getting hit by a double whammy. For one, TSMC produces the chips for the majority of Apple's products. Then also, Apple gets a lot of their phones and hardware assembled in China. So a 10% increase in Chinese tariffs will also impact Apple. And then you add that on top of the fact that Apple has barely grown in the past 3 years. Their revenue in 2022 was $394 billion, and last year it was $391 billion. So if we're being generous, they've been flat. However, this is still a wildly profitable company that generates $118 billion a year in cash from operations and over $100 billion of free cash flow. And in terms of the stock, they've been juicing the stats a little bit by funneling all of that money into share repurchases, basically. And that lowers the share count, which is why it kind of appears like their earnings per share is increasing. But to the degree it is, it's mainly because of share repurchases. Now, don't get me wrong. Nothing I'm saying here is calling Apple a bad company. I actually think they're still one of the best companies in the world. And perhaps they'll do a full Apple stock review in the future. I do still own the stock myself. I just really would not be adding at these prices. And I do think they're definitely at risk when it comes to tariffs compared to other big tech companies. As I mentioned, this does create interesting incentives, and Apple did announce a plan to invest $500 billion in the US over the next 4 years to increase their US manufacturing. However, this will take quite a while to build and become active. And even then, that will only partially reduce their exposure to potential tariffs. For stock number 3, we have Nvidia, ticker symbol NVDA. This is the dominant AI semiconductor company. They are the chip designer, and they get their chips manufactured in Taiwan by Taiwan Semiconductor. So the impact of tariffs will be felt by them. Nvidia stock is down 12% over the past 5 days, and it's down 17.5% year to date. Now, the bright spot for Nvidia investors is that this is an insanely high quality company with a dominant position in AI. As you can see, their earnings per share have exploded as the demand has increased recently. And this is also an insanely profitable company with 75% gross margins and 55% net margins. So Nvidia has a lot of pricing power to pass it along to their customers. And in the worst case scenario, they have a lot of buffer room with their margin. So if you were already bullish on Nvidia, you're believing in the AI bull case and the continued build out of AI data centers over the coming years. And in that bullish scenario, the growth rates from this will outweigh the impact of tariffs, in my opinion, to a significant degree. If you excluded tariffs, then I guess the bull case could have been higher. But as you're factoring in tariffs into your investing strategy, I think you should really keep in mind the idea that a great business is still a great business. And if there are real structural growth waves happening, that will still continue. However, this is a new negative introduced to the story of Nvidia stock, and definitely something you should factor into your analysis of the company. For stock number 4, we have Broadcom, ticker symbol AVGO. This is another fabless chip designer. They get those products manufactured by Taiwan Semiconductor. The company has seen very good earnings growth in recent years. The bright spot for them is that they are increasingly becoming a software company as well. However, the main growth story of why everyone is buying Broadcom stock at this recent valuation is their AI semiconductor business, which is a small but fast-growing part of their semiconductor business. Broadcom stock was down 6% yesterday and down 19.2% to start the year. This is a company which historically is beloved by dividend growth investors. I owned it for a while, went up about 200% and then sold. Revenue per share has grown at a 20% 10-year compound annual growth rate. Free cash flow per share has grown at a 30% 10-year CAGR, although this has slowed down significantly in recent years. The Broadcom dividend, which is paid quarterly, has grown at a 12% 5-year compound annual growth rate, and it is very sustainable based on free cash flow. I've done full stock analysis videos on Broadcom stock in the past, so definitely go check those out if you're interested. However, it is important to have on your radar that this company could directly be impacted by tariffs. For stock number 5, I have Qualcomm, ticker symbol QCOM. Once again, a fabless semiconductor company which focuses on design, getting their chips manufactured by TSMC. This company also just reported record high earnings per share. Their stock was down over 2% yesterday. It's down 11% over the past month. And again, they will be importing a large amount of their chips from TSMC, so they will be paying this tariff that could impact the margin of Qualcomm. And it should be noted that compared to all of the other companies I shared today, Qualcomm does have the lowest margins, both on a gross basis and net margin basis. That said, the fabless semiconductor model, which is a fantastic business model when it comes to capital expenditures and generating high free cash flow, Qualcomm's free cash flow is fantastic. They just had a record high in the recent fiscal year, and the 5-year compound annual growth rate of free cash flow is 13.5%. Qualcomm is also a dividend growth stock. They have a long history of annual dividend increases. The 10-year compound annual growth rate of the dividend is 7.3%. The current dividend yields 2.2%, and it's actually a very sustainable payout ratio based on both free cash flow and earnings per share. They have a 33% free cash flow payout ratio and 36% earnings per share payout ratio. And what I'll say about Qualcomm and really all of the stocks I mentioned today, they are extremely high quality, profitable businesses, and really all of them can bear the cost of these tariffs. But it's still a cost that will impact this entire supply chain. So it is a factor that will be included in the stock analysis of these companies. And because of that, there could be volatility in all of these stocks and in the broader stock market, because tech is only one sector that will be impacted from tariffs. So you should be aware of this volatility, but you should not be scared of it. You should try and think with a long-term mindset. There will be many high-quality companies that could be trading at attractive valuations because of this volatility. And in general, I would implore you to have that mindset when taking a look at all this news. I know that I am. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to use the stock research tool I showed throughout the video, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. And right now we're doing a special sale where you can get 50% off the annual membership. So definitely check that out if you're interested. It will only be available for a limited time. With that said, thanks for watching, and I'll see you in the next video.